What's going on, penny boys and gals? What's going on, stock traders? And welcome to our PBU Live. This is our Charting Master Course edition. This is week 6 out of 8 of our Charting Master Course. And as you can see, Jay is copying and pasting all the
Yeah,
different weeks from the syllabus onto his chart. I love it. And yes, here we are on week 6, and we're going over Fibonacci. We already did support and resistance. We did trend lines. We did supply and demand patterns, divergence, and now we are here on Fibonacci. Next week is time frames and indicators. Then week 8, we're wrapping it all up and just putting it all together. But I just want to ask you, Jay, how are you doing?
doing pretty well, man. How are you doing?
Good, good. I'm ready. I'm excited for today. I know Fibonacci, unlike some of the different weeks and the topics that you okayed, by the way, some of the topics you weren't so fond of, like trend lines and some of the patterns.
Yeah, well, yeah, yeah.
I know
Today
Fibonacci
we're
is one that you like,
yeah,
though.
today we're going over something that is absolutely essential in my own trading strategy and my own trading plan. And in looking at the markets, Fibonacci is a huge component of that. And indeed, as you said, I've pasted out the previous weeks and the topics that we've had up until now. And I wanted to do that because I think it is very important to have an understanding of what we're actually doing in here. So we're actually diving in deeper into something that we've already talked about in week 1 when we talked about horizontal support and resistance. So horizontal lines. And back then I clearly said horizontal lines come from different sources: swing high, swing low, high time frame fair value gaps, and high time frame Fibonacci levels. So high time frame Fibonacci levels, you could basically, if we disregard all the other things like trend lines, supply demand patterns, and divergence, Fibonacci is actually the first thing that I would say, well, yeah, this is crucial because this is something that you really want to master, want to get acquainted with, because this is one of the 3 sources of horizontal support and resistance lines, right? If that makes sense. So today we're going to dive in deeper into which Fibonacci's I personally use, what they are, how to use them, and different use cases of them. So yeah, that's the first thing. I don't know if you wanted to add anything to that, Doug.
Yeah, no, I'm excited for. I can hear myself now. I hear the echo.
Oh,
I know you're talking about now, Pookie. But no, I'm just excited because I know you're saying the fair value gap is how you find different levels. When there is past price pattern or past price movement in those levels, and then Fibonacci is one way that you determine maybe possible targets. When there has been
yeah,
past price action in there. So I'm excited for today's class.
awesome, dude. Now, Fibonacci, I know that you have a basic tool on Webull where you can draw Fibonacci's. I personally still believe that for a lot of the things that we talked about, you need TradingView. You need a TradingView subscription. You need to be able to put trend lines, sorry, not trend lines. You need to be able to put alerts on horizontal lines. That makes your life so much easier. If you take this serious, I think having a TradingView subscription is a great thing. And I personally, on TradingView, so where do you find Fibonacci? Well, it's basically a tool, not really an indicator. It's more like a tool. So if you go to the left here, my third column, my third row, I personally only use Fibonacci retracement and trend-based Fibonacci extension. So I'm not the person to teach you about a Fib channel, uh, time-based Fibs, all of these other Fib spirals, Fib circles, Fib wedge, whatever, all of these different things. That is not what I use. So today we can take a look at Fibonacci retracements and extensions. I can tell you that that is quite complete. I never ever feel that I'm not prepared just with those 2 variants. So those 2 is what we will be using. And I definitely want to make some examples here with use cases. And it's quite a theoretical class. So if you want to make notes, you can do that. Otherwise, I'll be trying to put in some notes as we go along because I want to keep this structured. So we have Fibonacci retracement and we have trend-based Fibonacci extensions. My suggestion is that we start off with explaining the Fibonacci retracement, right? So that is the first one that we will go over. Basically, the Fibonacci retracement, the biggest edge that that tool gives you is basically in a context where a chart is looking to make all-time highs or all-time lows. You have nothing, no prior price history to understand where that ticker might trade to. But if you know how to draw Fibonacci the right way, then you can make very accurate projections in price discovery mode, where a chart again is looking to make a new all-time high or a new all-time low, where you can very accurately predict where the price is likely going to see some kind of algorithmic reaction. The way that I've seen it, if you draw them right, correct, those Fibonacci levels are definitely no joke, and they give you a huge edge, because before price is even trading to a level, you already know exactly the price where you can play around. So that is a key component of any trading strategy. First, you need to find levels, and then you need to have a trading strategy on how you're going to get into a long or a short position from those levels. But if you can already manage to look at the right levels, then you will have an easier time in the market just going forward, and you will skip taking trades that, well, if you know about these FIBs, you will skip taking trades that make no sense, where the FIB target basically is not hit yet, and you're basically too early in the market. So Fibonacci retracement, there is two ways that I basically use them. So I'm going to show you two use cases of Fibonacci retracement, and I'm basically going to make some notes here on this chart. And I was looking at the snowflake chart today, and this sticker lends itself very well to explain you both variants on the Fibonacci. So I suggest that we could stay with this chart, and I'll make some notes on this chart as we go. So there's two variants of Fibonacci retracement that I personally use. One is Fibonacci retracement to project upside and downside targets, right? That is going to be the first use case, is that if you're trading somewhere, I want to know where is this sticker going to go to if we break up or down. I want to know very accurately before price comes anywhere. I want to be aware of what could be the Fibonacci level to look at. So to project upside and downside targets, and those Fibonaccis, they basically project up and downside targets, and they also come with a golden pocket. Plus golden pocket, that is something that we'll go over as well. And the second use case of Fibonacci retracement is if I'm looking to draw out a range. Very simple, and I'll show you how I draw Fibonacci's in a range. In a range, I want to be aware of a couple of different levels. I want to know the range high, I want to know the range low, I want to know the mid level of that range, and I want to know the upper and the lower range quarter. For that, we're going to be using Fibonacci retracement tool to mark out a range. Now, there is one key difference in Fibonacci 1 and Fibonacci 2 that we're going to be using. Both of those is the same tool, right? The Fibonacci retracement tool, same tool, but two different use cases. And the main difference is that for the first use case, we're going to be using log-based FIBs, and I'll show you exactly what that is. And for the second set of FIBs, for the second use case, we're basically going to use non-log-based FIBs. But again, this terminology, I hope it can become clear as we move along. So I would say, well, we can start off with the first variant here. So Fibonacci retracement to project upside and downside targets, also giving us a golden pocket, and I'll explain what that is as we go along. So that is going to be with log-based FIBs. Now, if we're going to be using logarithmic-based FIBs, you want to be sure that your chart is on a logarithmic setting. So on TradingView, if you go here on the bottom right, this little thing, you click on logarithmic. That is one problem, and also another reason why I do not use or like to use Webull all that much for FIBs is, and maybe there is a way to put it on log scale, but I have not found a way to use log-based FIBs on Webull. So I have not really delved into it. I always had TradingView, and I will continue to use it. So again, if you want to follow along with exactly what I'm doing, then you would need the exact same, platform and software that I'm using, or find the exact equivalent on whatever else you're using. So I'm going to move out those horizontal lines from my chart. I hope that this is clear, right? That we're making a jump back to week 1, because in the end, what we're going to be doing here is determining horizontal support and resistance levels. That's ultimately what Fibonacci levels are, right? They're always going to be horizontal levels that we can use as support and resistance to play from. So, okay, Fibonacci on log-based FIBs, first things first, you want to be on the logarithmic setting here, right? So Fibonacci retracement to project upside and downside targets plus the golden pocket. And now we come basically back to, and this is the main question I get from FIBs, is people asking me, where do I take my Fibs from? Like, do I take it from the wick? Do I take it from the candle close? From which candle to which candle do I take it? And then we come back to week one, right? Exactly the same thing. Is the first thing you want to be acquainted with here before touching any Fibs is you need to be able to look at a chart on a high time frame, and you need to identify important swing high and swing low. So the only way that you're going to get good at that is by doing it often and again, asking if what you're doing makes sense, right? So if I'm just, and this is the first thing, so we will get to Fibs, but again, you need to know where to take those from. So swing high, and as a general rule of thumb, I always take my Fibs from wicks, because those wicks, that is where price went, that is relevant to me. I do not disregard the wicks. So swing high, trades down to here, swing low, bounces up to another swing high there, comes back down, and again, this is the exact same thing as what we've done in week one, but it is just so crucial that you can identify swing high, swing low, and not something in the middle there. If you're using a weekly time frame, just do it like this: swing high, swing low. From this point, the lowest point that the chart went to is here, then the highest point that the chart went to is here, then the lowest point the chart went to from here is exactly here. So that is the low. If we're going to say, well, swing low here, and then what is the highest point after hitting that swing low is right here. Well, now this allows us to take a Fib, basically. So we have all of these swing points, swing low, swing high. What you could do is take, again, a Fibonacci retracement here, and basically you would start from the bottom and draw it to the top. And I'm going to quickly get this out because this is not the use case that I want. It's Fib levels based on log scale. So you want to double click your Fibs, make sure that this is based on log scale. And what we are basically going to use is 1272, 1618 Fibonacci's, and then the 618, 0.618, and one Fib that is basically not standard, but if you're on TradingView, you can create your own Fibs here. The 0.705, right? That is an important Fib that I use, and I'll explain you why in just a second. Also, if I quickly go to Twitter, right, my handle here on Twitter is BTCJ705. That has a reason, because the 705 is a very important Fib. People are always looking at the 0.618 Fib, but the 0.705, that is a Fib that gets hit very often, and it's not a traditional one, but that is what I put in, and I'll explain you about the golden pocket in just a second. So I took Fibs here from this swing point to this swing point, and that gave us.
Oh, wait, Jay, I'm sorry, really quick. Can you just put that screen back up and just because those are kind of really small? Can you just say those again just one more time? The numbers.
Sure. So the numbers that I use for this first variant, Fibonacci retracement to project upside and downside targets plus the golden pocket, right? I use the 0 and the 1 Fib, that is standard, the 1272 and the 1618, and then 0.618, so your 618 Fib, and the 0.705. That is what I use. So I'm not looking at 0.23, whatever, 382, 0.5 for this specific set. That is kind of what I use. So 1, 2, 3, 4 Fibs, 2 Fibs outside of your range, and then 2 Fibs in the range itself that are important. So here you have it. Let me know if I can click this away.
Oh, yeah, you're good.
Yeah, good. So again, I took, and this is very important, and why, and the same thing applies, right? I've said it every single week. Whatever we're talking about here, it is the strongest on higher time frame. So you can apply the same exact concepts on a 5-minute time frame as what I'm showing you here, but just know that the real value and the real edge of Fibonacci is, in my opinion, to find high time frame horizontal levels of support and resistance, right? The higher time frame, the better. So I'm using an example here on the weekly time frame that is very good. So what does that give us here? If we have a swing low and then a swing high, we could use the replay button and put us back here. But ever since we've hit swing low, swing high, we've traded down, and then ultimately this area here between the 0.618 and the 0.705 on the log scale Fibs, that to me is what I consider the golden pocket. The golden pocket is the ideal retracement where you would like to see a higher low to then continue your trend, or a lower high to continue your trend. So whatever falls within the 0.618, 0.705, that is an important level. If this is a low, that is a high. the retracement that you want to see held is 0.618, 0.705. I know that a lot of people, they look at this 786, and in this example, that is the fib that hit. So you could also play around with it a little bit, but 0.618, 0.705, that is crucial. And then if you want, you can use the 786. So essentially what that gives you is horizontal levels of potential support where you can play around from. And then we could go into what is the trading strategy itself, which is getting below one of those levels and then closing a 4-hour candlestick back above. But yeah, just explaining you what are these levels. So if you see price went down, traded down, but never broke that low, and then eventually held support on the lower fib here, the 786, and then the moment it basically got back above and flipped the 0.618 into support here and then here and here again, that is bullish confirmation that down there is a lot of resistance to go down. And if this bucket is holding like here and here, and gives you a projection to basically go back to the 0 fib, which is the swing high point. So if you have a swing low and a swing high, price here is either going to trade back to that high or to this low. So you can use that 0.618, 0.705 bucket to kind of guide you. So if you would have gotten below those levels and flipped that into resistance, then what becomes more likely is that you trade to the 1 fib. And then we come to the 1272 and the 1618, which is a super big edge, right? Is that we can project upside and downside targets. And this is also a context where this chart would make new all-time lows if it would break the 1 fib. So people have nothing to work from here for the left to know where is price likely to find a reaction. But if you know about this and you know exactly how to draw them, so from swing low all the way to that swing high, that is the macro move here. This is the lowest point, and then the highest point the chart went to on the bigger picture is right here. Well, if that 1 fib, if you lose that, then everything here becomes basically continuation of a downtrend, and you would know exactly where to look to basically look for a long position at the 1272 or the 1618 fib, because those are the levels, right, where you will see an algorithmic reaction of profit taking from short positions that basically cover here because they know that that is the level where all the big boys are going to cover. And if you know of that, then you also can basically determine trading strategies to get in at very, very decent entries where you already know well in advance if this level breaks at any point in the future, you are not looking to trade anything between this and this. All of this white area here then becomes a trap, and you're too early, very likely, if you're trying to go long. You want to do it from those predetermined levels, and that's really what Fibonacci gives you here. 1272, 1618. Now, if all of those levels break, the levels that you can add in then as price moves lower and lower would be the 2 fib. So you have 1272, 1618. That is good to start with, and usually you will see already a reaction here or here. But if it goes lower, then you use the 2 fib, the 2272, and the 2618. And so you have 1272, 1618, 2, 2272, and 2618. And then you would have 3.272 and 3 and so on and so forth. So those are all the levels where price could trade back to if at some point this low would be lost, right? But I can use these fibs for both ways. So I have my downside targets here if I take my fibs like this. So where my 1 fib is the low, my 0 fib is the high. And basically what these Fibonacci retracements are showing you here is basically if you have this low and that high, 786 here is basically you've retraced 78.6% back to this low from that high on the logarithmic chart, on the logarithmic scales with log-based fibs. But say that indeed price is going to move, for example, to this high here, right? So this high, then instead of wanting downside targets, maybe we also want upside targets to aim for. That is also possible, right? So I'll take out these fibs for a second, already like showing you how to project to the downside and exactly where to look at. You're going to, and once again, I'll actually put this back on because I want to make this clear again. People then ask, why on log scale? Well, I'll show you. If I use fib levels based on not log scale, so if I tick this option off, right, then what ends up happening here at some point is my lower fibs are going to literally give me negative values here. So at some point, if I draw these fibs on non-log scale, it's literally going to project below zero, right? And that is impossible. A price cannot go below zero. So I personally do not attach value to up and downside projections on non-log based FIBs, because I know that at some point that would literally project you below zero. So we can fix that by ticking on fib levels based on log scale. And that way, no matter how low the price, how low of a fib I take, it will never tell me that price can go below zero, right? So that is why I use those levels. I've also done the work. I've played this a lot. I've used these fibs like so many times, and I can truly vouch for the fact that those log scale fibs work. But again, I was going to also show you the upside projection, how you would get upside targets right here, right? So I'll take out these fibs, and I'll take out this and this and this. We can leave these two lines, and eventually, like, I don't particularly like charts where Fibonacci's are, it basically clouds the vision of your chart. At the end of the day, the only thing that needs to give me is a horizontal level below me. I don't need the fib on the chart itself. So I take my fibs, draw my horizontal lines, set alerts on them. I have my trading strategy from it, but then I move those fibs off because it can cloud my chart for too much, and I like to keep it simple, right? So going back here to reading price action, which is the key part. Well, slim pickings. TradingView not letting me check log scales. The reason for that is probably because your chart itself is not on a logarithmic chart yet. So again, what you want to do, you could right click here on the price and tick this on logarithmic. You need to have your chart on logarithmic first before you can project Fibonacci on log based settings, basically. So that should help. Or you can click on this cog here and make it logarithmic. No, not at all. It's good that you asked the question, Slim Pickens, and I welcome you to TradingView. I truly think that this is a great tool if you know exactly the things to use. Yeah, and Webull, I talked about it a little bit before, but it is not. I draw some fibs here and there on Webull, but the real work and the absolute accurate levels are what I find here on TradingView. But anyways, we got downside projection, and I showed you that golden pocket, right? So for me, the golden pocket is the area between the 0.618 and the 0.705, right? And that is essentially what you want to see held for the move back up to the zero fib and then the other direction. Now, if we wanted to project to the upside here, right, we have swing low, swing high, and then you should ask yourself the question, after price made this high right here, what is the lowest point that this chart went to before basically going back up? Well, it's right here, right? After this high, the lowest point that this chart went to is right here at 119.27, right? So swing high, swing low, and then from there, price never breached that low again. Now, if you want upside targets, instead of taking the fib from the low to the high, you take it from the high to the low. And it's literally the inverse opposite. And you can kind of see, I will take my 786 fib out here, right? And I'll also take out that 2618 and all of those. I'll just keep it simple with 1272, 1618. But what does this give us here? Well, it gives us 4 levels, the ones that I showed you, right? 618, 705. And what is happening here? So we have swing high, swing low, price moves up, and where are we finding resistance? It's exactly off my 705, 618 pocket right here, right? You can see that chart again on log scale, wicks in it. If you know that, those are high time frame levels of resistance, right? The golden pocket to go back down. Well, if you see that price is wicking above that and closing below it on the 4 hour, those will become triggers to short. And again, it sounds simple, but you will need to do it a lot of times before that truly clicks. But when it does, it's a huge edge, right? So price finds resistance in the golden pocket, trades back down, never loses this low, and then trades back into this golden pocket, back below, turns it into resistance again here, and then finally breaches it. So by knowing that you're now above that golden pocket, 618705, you can look for the move back to the 1 fib and then project to the upside by using the 1272 and the 1618 Fibonacci's. So 1272, 1618, that projects to the upside here. So in case that 1 fib breaks, it's basically the retracement from this high to this low that is going to determine how high you can go to the upside. And the bigger the retracement, the higher the upside targets. If I move this Fibonacci level a little bit lower, look at what happens with my 1272, 1618. So the deeper you retrace, the greater the impulsive pace. So the deeper your retracement, the higher you can go if that swing high breaks there. But for now, right, just respect what it is showing you, swing high, swing low. We have a target at the 1, and then you know that's a high time frame level of resistance. If that flips into support, then this is the level that you're trading into. If that flips into support, 1618 at 287.99, which is a very accurate level of resistance that I'm already aware of for Snow, way in advance based on this swing high, this swing low. That projects this. So if I know that that is a high time frame level of resistance, again, I can apply a trading strategy, right? Move above, 4-hour candle close back below. That would be your swing short trigger from resistance higher up on these, based on these fips, right? So showed you, I could literally, if I take all of these things out, right? I could show you both the upside projection for Snow and the downside projection based on these Fibonacci retracements. And if I want to just, for example, get out the 618 and the 705 on both of these fips, I can do that. And you literally have the scenario that, well, if this low breaks, we know to look exactly here and exactly here. If that high breaks and flips into support, we know that we need to look exactly here and exactly there. So that is the first use case, Fibonacci retracement to project upside and downside targets with the golden pocket, which is, again, that 618705 level. Hope that makes sense. Maybe you will need to rewatch this. Again, one thing that you guys are basically lucky with is that I'm not one to change my trading strategy every week or this or that. No, I have a system, and you're going to be able to see the same thing over and over and over the course of months and even years. So at some point you will recognize it again and again and again. So yeah, that's basically the first part of our session here on the first log-based FIPS to project upside and downside targets. So I hope that's clear. Duck, if you want to add in anything before I move to the second use case of it.
Oh, all good.
Good. So I'm just going to remove everything. We need to move on a little bit because I still have two different things to talk about, right? So we're still going to, for the second use case, we're still going to look at the Fibonacci retracement. So the same tool, but with a different purpose. And then I'll briefly go over trend-based fib extensions, but I can already tell you that I don't use anything else than retracement and extension fibs. And the longer I've been charting, the less I use these trend-based fib extensions, but I will show you how to use them if you want to. But if you know what I'm telling you here about the Fibonacci retracement with the two use cases of that, you already have everything that you need to get from fibs, basically. You already got everything that is the most worthwhile. So the second use case of Fibonacci retracement, so again, fib retracement, same tool, use case 2, is not to project up and downside targets, but is to simply mark out a range. And if we're going to mark out a range, I am not using a logarithmic chart, but I am rather using a non-logarithmic chart and non-logarithmic fibs. And it's very simple, this second use case. So if I am looking at a range, and we can once again go from this low, which we've marked out previously, and we've used this point for the downside targeting, and then this high, right? This kind of gives us a trading range. I could go to some other charts. Recently, we had a very successful play with the second use case on the donut chart, DNUT. I might go to that chart just to show you there as well. But for now, right, this is swing low or range low, and this is our swing high, and now also our range high. So as long as we're not breaking that high or breaking that low, it's quite early to project already to the upside or already to the downside. It's also ideal if you know what is happening in this range itself. So that 618705 fib that you saw on the previous use case of fibs, right? I also use that less and less. If I'm trading in a range, I will use these fibs, which is basically a Fibonacci, also from swing low to swing high, or from your range low, where the lowest point you went to the highest point you went here. And instead of using the 1272 and the 1618, we're going to be using, again, the 0 and the 1 Fib for your range high, range low, and then the 0.5, which is going to be the exact middle of your range, and then the 0.25 and the 0.75 Fib, which is the upper range quarter and the lower range quarter. Now, for these Fibs, you have one advantage is that it doesn't matter whether you draw it from the low to the high or from the high to the low, because you can see I can draw them both ways, and it's going to essentially give me the same levels, whether this is the 25 or the 75, doesn't really matter. That quarter stays the quarter. With the Fib levels based on log scale, it matters very much from where to where you take your Fibs. And again, if something is unclear, you can ask and try yourself and rewatch the recording and so on and so forth. But this right here, right, this use case of using Fibs, what it gives me is basically, if I say that's range low, that's range high, it gives me the middle of my range, the upper and the lower range quarter. So again, those are horizontal levels of support and resistance, and it's very simple. If you break a Fib, you go to the next one. So right here, we're trading, you can, and it also helps you to section your brain and your mind, so you can see, okay, that's the top end of my range, that's the bottom end of my range. If we're going to break this range, I know that I can use those first set of Fibs to project upside. I know already where I'm very likely to find resistance. I can project downside if we lose the bottom. But as long as we're in this range, I just want to know what is the middle, upper range quarter, and the lower range quarter. And the idea is very simple, right? It's a support or a resistance level depending on whether you're trading above or below it. So right now, we're trading at 187.68 for snow. After hours, 187. So that is above the 0.75 Fib here, 181.81, right? So we know that that is a support level, and that if that level is going to flip back into resistance, we could expect a move back to the mid-range. And then maybe from there, we see a bounce. And also to me, again, the mid-range is the key pivot here. If you're above the mid-range, my bias is move to range high. If you're below the mid-range, my bias is move to the range low. Eventually, with one stop at the range quarter here. But if you look at this, and again on the higher time frames, I'm very much advocating using Fibonacci here on the higher time frames to give you an outlook, and not just to use it on 1 minute time frames and so on and so forth. But if we go to a lower time frame from here, and again you draw your Fib levels on a weekly time frame, but then you go to your lower time frame and you leave those Fibonacci levels on. So it's very important that on lower time frames, you know where you're at, right? So on the 1 hour time frame, if I then zoom into that, I clearly see that 0.75, this is my upper range quarter. This is a level. If we're below it, I'm going to treat it as resistance. But now that we're above it, I'm going to look for that to flip into support. And on lower time frames, you see that flips into support. And today we took a trade based on the idea that this thing is actually, it's a support level. We're confirming it to be support. And then right here we got in, and we're ultimately targeting to the range high there. Obviously, you can take your profit on intraday levels that are important, and then go to your daily time frame to maybe look at some intermediary levels where you want to scale out of your position. But those levels give the best case scenario targets, basically. And you kind of know, right? The upper range quarter, that flips into resistance. That is also a cause of concern. So if you are, for example, long here right now, and the price is going to do something at this exact level where it's going to get below it and it's going to flip that into resistance, I would not keep sitting in the long here, because I would have a bias that we could move down to this level. At which point, again, move below 4-hour candle close back above, or a lower time frame candle close. If that is your preference, that would be the trading strategy, right? So that is how to mark out a range, and how to basically you treat this level as support or resistance based on whether the price is trading above or below it, right? So it is actually a very nice example. So we got above the mid-range, held exactly support there, then toyed around for it a little bit, exactly held this level as support, and then we basically gapped up higher low, and we went and we got zapped to the next Fib level. So as long as you're trading above this, that's the outlook. If you start turning this into resistance, you're looking back at the mid-range. Obviously, you can take, you can, again, on lower time frame, manage your position as needed. But those high time frame levels, they are a very good guidance in knowing, oh, yeah, this level is supposed to be support, but it's not anymore. It's actually flipping into resistance. Let me just take a look at the next Fib, right? So that would be the second use case of Fibonacci retracement. So the retracement tool, one, to project up and downside targets with a logarithmic chart and logarithmic based Fibs, and use case two, to mark out a range, non-logarithmic chart, non-logarithmic Fibs, and you're using the 0.5, 0.25, and 0.75, right? Again, there is absolutely no shortcut to getting an understanding of Fibs unless you are going to do it very much yourself, right? You cannot cheat yourself out of drawing these Fibs many, many times and asking yourself, if this is this right, is this not right? Again, you're in the right spot because you can literally ask us whether it's right or not, right? So I'm just going to pause it here again for a second, and then if that is clear, I'll quickly, well, not quickly, we'll take our time to look at the last variant here that I want to talk about, the trend-based Fib extension. So, Duck, I don't know if you want to add anything or.
Stickman said it best. He said a few light bulbs turned on, plugged in, made a few revelations already. I think that
Awesome.
This is definitely clicking. I'm excited for extensions.
Very good. I'm very happy to hear it. So I'm gonna remove this for a second and let's quickly go to maybe another chart, Tesla. And my my recommendation to you guys is, now you're getting information about all these Fibs, but don't try to use it all at once. So again, I'll repeat it. You could be most efficient if you're very lazy. If you're a lazy person, that is in some ways very good. You would basically dive very deeply into what I just talked about on the Fibonacci retracement, because that again gives you everything you need to know. It both tells you where to look inside a range, and as soon as you're going to break a range, you can also use it to project for up and downside. Now, the second tool here, trend-based Fib extensions, right? I personally, again, this is only one setting. It's again going to a logarithmic chart, and I personally, again, if I'm going to take these Fibs, I'm going to always make sure that Fib levels are based on log scale, right? To move that out for a second. Basically, the name says it, right? Trend-based Fib extension. Basically, the Fib retracement, you take it from point A to point B. There's only 2 points that you need to worry about, a swing high or a range high to a range low or a swing low, right? But for trend-based Fib extensions, you will click 3 times. So you need 3 points. Well, you always need already the start of a trend. So again, the first thing that applies is that you always are able to read swing high and swing low points. So swing high, you could say this is then swing low, this is lower swing high and then lower swing low, before another lower swing high here, the highest point, before then actually falling off a cliff and making a lower swing low here. Then from this point on, something changes, right? The chart goes up to this point, the highest point it went to, and then comes down and basically doesn't go lower than here. Well, you could say this is a low, this is a high, and this is a higher low. Now, the moment that your high here breaks and you make higher high, so high, low, higher low, the moment that high breaks, you're confirming an uptrend because you then both have a higher low and a higher high. You want to be able to know where is that higher high potentially going to come at, right? And one way to do that is to use a trend-based Fib extension, and you basically take it from the lowest point, so from the start of your trend, which is here, the low, goes to the high. So you take it to the high, and then it goes, the lowest it goes is right here, which is the higher low. If I'm going to use trend-based Fib extensions, my suggestion is move all of this stuff out between 0 and 1. So all of this. The only thing that you really need to be concerned with here is the 1272 and the 1618 targets. And if those targets get breached, then you can use the 2 Fib, the 2272, and the 2618, right? But at some point, you will be able to use different Fibs and so on. So for trend-based Fibs, it's very simple. I use the 0, the 1, and then the 1272 and the 1618, right? So again, with a chart on logarithmic and Fib levels based on a log scale. If this is a low and this is a high and this is my higher low, then those trend-based Fibs basically project upside to the 1 Fib, the 1272, and the 1618. So that is the measurement where the trend should find some resistance here. So 325.74, that would be the first very relevant level to trade into based on these trend-based Fib extensions. But you can use them both ways. You can use them to determine upside targets, but you can also use them to determine downside targets. So for example, right, here we have the start of an uptrend because we have a low, a high, a higher low, and then we confirm the uptrend by breaking this high, right? Well, the opposite is true here. We have a high, a low, and then we make a lower high before making a lower low. So if we take it from, again, the start of the trend, which is this high, you go to this swing low, and then to this lower high, right? Then these trend-based Fibs basically project downside targets, which the first one here would have been 216.33, right? So if you would have known about these Fibs, high, low, lower high, you would have known 216.33. That's something to look at. Then 185.03. Now, if I mark out these levels, right, just for an experiment here, 216.33, right? That is right here. Let me get it right on. Price wicks there, respects it, wicks there, respects it, wicks there, respects it, and then goes up a little bit. Ultimately, then you break that 1 Fib. The next Fib that you look at is 185.03, right? So that would be here. Well, price still went lower eventually, but before price went lower, and make that like this, right? Before price went lower on this week, you clearly had some support there. So wicks below, gets back above, and actually from that level, you get a little bit of upside to here. And then so on and so forth. So again, if the 1618 breaks, you would look at the 2 Fib, and then you would look at the 2272, and then the 2618. Now, with these Fibs and with these levels, I never suggest that you place orders just on these Fibs blindly, because there's going to be examples, right? For example, right here, where you could have said, well, 151.67, that is now my 1618 Fib. We're probably going to see support there. Let me just blindly put an order there. Well, sometimes you can do that, and you can get punished for that a lot, right? Because price finds no support there. So you need some kind of entry criteria, is trading strategy around those levels. That is very important, because eventually what happens, price goes lower and then hits support all the way down here at the 2272 Fib, literally wicks there, and then closes back above it and reverses the trend, right? But what I'm doing here, projecting to the downside, so it's basically projection Fibs, so continuation of the trend up or continuation of the trend down. I can do it like this, but I also just explained you that I can use my Fibonacci retracement tool to project to the up and down side. And this actually has my preference. So one way to project the upside here is to take these trend-based Fibs and to say, well, swing low, all the way to the swing high, then to this higher low. This is my first target at 325.74. Well, that's fine. But if you would have taken the first option, the Fibonacci retracement option to project to the upside, you'd have said, well, this is a swing low, swing high. And then after we broke that swing high, you could have taken your Fibonacci retracement from this level to the lowest level that it went to, which is right here. And using the 1272 and the 1618 setting again on this tool, right? Fibonacci retracement, Fibonacci levels based on log scale. And then what does that give you? A 1272 and then a 1618. That 1618 here clearly is showing us a more accurate level of resistance, right? At least for now, than what this option is showing us, right? So this option is showing us 325.74. Well, we didn't quite make it there, but the 1618, based on these on the first option that I shared with you here today, that would have said, well, 271.31 is an important level, wicked of it, briefly got above it, got back below, flipped into resistance, never could reclaim that level, and then we got sold off from there. So to me, these levels are more important. And again, that 1618 up there, 271.31, that is now the level to break for Tesla to basically look for upside continuation. And if we're going to get that upside continuation, then I could simply look at these Fibs and say, again, if it breaks the 1618, the next level we go to is the 2, and then the 2272, and then the 2618, right? So that would be 310.9 and then 342. But I hope that I could also explain a little bit on how you would use the trend-based fib extensions. But again, all of the other stuff, I don't know how to use. I've never needed it to make money. And I think you would be best off by really diving deep into what I tried to explain today here on the Fibonacci retracements. But I'm not saying that you cannot use the fib extensions. One thing I will say is, again, the same thing with these fib extensions, right? So at some point, if I'm on a non-logarithmic chart here, if I use these settings here on a non-logarithmic setting, right, then at some point, a downside fib can project below zero, which again, that is not possible. And that is exactly the reason. So as a general rule of thumb, just try to remember this. If you're projecting upside or downside, you will always need a logarithmic chart with logarithmic fibs. It is only when you're trading in a range and you want to know in that range what is the middle and what is the upper end of range quarter and the lower range quarter, only then do you use a non-logarithmic chart with non-logarithmic fibs. Projections, as a general rule of thumb, whether you're using the retracement fibs or the trend-based fib extensions, always use logarithmic and always use fibs on log settings. And again, I have not seen how to do that on Webull, which is why I stick to TradingView. But I'm already happy that I could bring these points across. Everybody is so silent. Even Duck hasn't said a word in half an hour. Everything is still all right there, buddy.
I keep echoing, and I don't know how to. I've been trying to fix it. Wait, stop. Oh wait, I'm not echoing anymore. I think I just left Discord and came back. Well, that's why I wasn't talking. But now I don't hear myself. So this luckily will be recorded. So anyone, I know myself, I'm going to be going through this class a few times. I'm going to be posting it in here once it's all done.
I'm well aware of the fact that this is a very technical thing, and like it is almost it's unrealistic to think that you will, in just 1 hour of listening to me, understand it completely again. Like you guys have no idea how many fibs I've drawn, like, and how many times I've seen those levels hit, and how many trial and error I've went to myself. But with what I'm telling you here, I hope that you can already cut your learning curve by a lot, because this is truly like the essence of it, right? The essence of how to use fibs, when to use non-logarithmic fibs, when to use logarithmic fibs, and so on. And again, if you want to keep it as simple as possible for yourself, you will just learn to use the fib retracement here. So I can keep giving examples and examples, but I also don't want to cloud your guys' brain for too much. One thing, I'll repeat it, I use these things all the time. So if I'm posting a chart in the analyst ID, or when I'm making a write-up, very oftentimes I will say this, and this level is important because that is the blah, blah, blah fib or the blah, blah, blah fib. And then I will leave my fibs on typically. So you guys can hopefully go to my chart and literally see, oh, where did he draw his 1 fib? Where did he draw his 0 fib? Why is his target there? And then you can literally just start by copying what I do, right? Start by literally copying what I do over and over and over again. And at some point you will truly start to understand it, which I truly hope that you guys will stick around and keep doing this.
Yeah, no, Jay, this was great.
I can give you so many examples, right? The Nvidia example is also a great one, where on the weekly time frame, right, we had swing high, swing low, and if you take it from the bigger picture, so if I go to the monthly here, like again, the higher the time frame, the better, right? If I go to a 3-month time frame here, which every single candle here represents a quarter, right? Then it would be very easy for you to see that this is a high and that this is a low, and you could easily project to the upside by doing what? By using Fibonacci retracement, fib levels based on log scale, and you are projecting to the 1272 and the 1618. Swing high, swing low. Again, the higher the time frame, the better. Don't be shy to go to a yearly or a 3-month time frame if you are having a chart with lots of price history. That is the most important thing that you can look at. So the higher the time frame you can find your fibs on, the absolute better it is. So swing high, swing low, project to the upside. And what does that show you? Well, it shows you 475.58 is an important level, and then if that breaks, you could look for way higher. Now, if you want, there is one like little bonus. Between the 1272 and the 1618, you have one level that you could add in, which is the 1414. So sometimes the distance between the 1272 and the 1618 is so big that you're like, okay, I want something in the middle of that where I'm also likely to find some good resistance. That would be your 1414. So if I go to the daily time frame, literally what is happening here for NVIDIA is that we're constantly basically seeing a deviation above this level of resistance. Again, this wick exactly taps that level. This wick here 2 days ago finds support exactly on that level. Now we're trading below it. What is the idea? This level is a support resistance level based on whether we're trading above or below it. So if we're going to trade below it, we treat this as resistance, and we know that we're looking at the 1 fib again in the bigger picture to be hit again, which is the previous all-time high for NVIDIA, also something that has never been backtested into support. The moment you get back above that 1272 and that truly flips into support, then you could look for upside to 1414, 1618. You also know if you're, for example, invested in NVIDIA and you're a long-term holder and you're already in it for a very long time, well, those high time frame fibs here and here and here, that is where you would do the opposite of DCAing, so dollar cost averaging in. This is literally where you would dollar cost average out at these high time frame levels of resistance if you're already in it for a long time, right? So you have very accurate levels that you can also say, well, I'm taking profit here, but I'm doing it based on my plan and based on the high time frame tips, and I know that I'm very likely going to get a good exit in the bigger picture. But with that being said, I'm almost gonna have to shut up because I think my lady is gonna want to go to sleep here soon.
No, this was a packed class with information, Jay. Definitely appreciate you coming on and doing this. Next week, next Thursday, 5 p.m. Eastern is going to be our week 7, going over time frames. Speaking of Slim Pickens' question on time frames.
Yeah.
So we're going over
Next week
time frames and indicators. And then week 8, we're going to be basically just going over all of it, just in general, just like, like what you use, probably just going over fair value gaps, Fibonacci, and just like time frames, and just really just putting those together, getting any last questions we have on that, and that'll be the wrap up of this charting master course.
I hope we get to do something after that. I hope we get to do something after that as well, dude. I'm gonna miss the Thursday sessions with you.
Oh no, we're definitely still doing the Thursday sessions. We can if you want to do like another 8-week thing, we could pick a topic. I think Pookie's and I are going to be doing an options 8-week version of this for the next set of classes next term, I guess, because our Penny Boys University premium classes go in terms of 8 weeks, and y'all can all find that over here. Make sure to complete the test in there. It's due in next week, I believe. You complete the test, you post in your trading plan, the trading plans channel. And those are easy ways to get entries to our huge merch giveaway coming up in the graduation stream. And that's how you become an alumni and get access to Pookie's and Bull's advanced alumni classes as well.
That is some good stuff, and I know it. I'm very happy to be a part of this team. What an amazing awesome group we have.
I'm so thankful that you were just so like you were just so willing to do this. I was like, I barely even had to ask. I was like, hey Jay, like I have an idea. I want to do a charting master course, and like here's what I think. You're like, no, let's do it. I'm like, all right, cool. So I appreciate you.
I honestly just want to be as useful as I can to Penny Boys. It's a great community. I respect everybody here so much. Like at the end of the day, I got fired from my job, and it took Quench 1 day to say, yep, you're hired. So I appreciate that a lot. And I just want to be useful to you guys.
Again, to the finding down uptrends, you said it does matter placing. Was it high or low? You see that question by Stickman?
Yeah, I see that question very well. So basically, you can project either to the upside.
You see it very well.
I see it very well. So
that's good.
I'll once again go to the snow example just to make that clear. So we can either project to the downside or we can project to the upside. If you want to project to the downside, right? So you want to know what happens when this low breaks here, then you need to start from that low. that is a good way to maybe remember it. If you want to know what happens when that low breaks, you have to start taking your fib from there. And then you take it to the highest point that the chart went to. And the opposite is true. If you want to know what happens when this high breaks, then you need to take your fib from that high to the lowest point that the chart went to afterwards. So depending on whether you want to know if this breaks, what happens when we go lower, or what happens when we break that, you start your fib from the point that you want to know what happens if this point breaks here. And you take it from the wick again, not from the candle close, from the absolute end point that the chart went to. I'm going to marry this man. Porter House. I really hope not, my friend, but I will come to meet you. Hope that makes sense. I got you, sweet. Yeah. We will keep practicing this. It's not something that we're gonna go over today and then we don't talk about this anymore. This is it for me.
Yeah, and like who knows, maybe in a couple months we'll do another go around this 8-week course, you know?
100%.
Maybe do like a 4-week course and take out trend lines and stuff you don't like.
Oh God, yes. This is the conclusion of this 8-week classes. We're gonna start with saying, what are we disregarding? Question 1, what are we not paying attention to, guys?
That's important though. It's knowing what to not look at, or even what to not trade.
Absolutely.
Half the battle. But yeah, we reached the hour mark. I'm gonna go ahead and end the recording, and then I'm gonna hop onto Discord and unmute you, Jay.
Perfect, dude.
All right.
I'm gonna stop sharing my charts.
Sounds good. For those of you watching after the fact, we appreciate y'all for tuning in. For those of you watching live, we definitely appreciate y'all tuning in. We have our next master class of the course coming up next Thursday, 5 p.m. Eastern. That's going to be going over timeframes and indicators. Today is Thursday, so we do have another live PBU live coming up later on today with Ethan. I believe he's going over how to build a trading plan. That's at 9 p.m. Eastern. And of course, tomorrow morning, we'll see you bright and early, 9:30 with Pookie's Revenge for some premium live trading. And all of y'all are premium members as we're in the lounge, so we'll definitely see you all there. And hope that we... Oh, ouch, my back. I hope that I see you there, but until then, I hope that y'all make some